Now, our next topic is report writing or reporting in general. And as we all know, the hustling we went through from beginning of studying auditing, then coming to evidence. After you have obtained your evidence, the next thing is you have to report. So, per your syllabus, report writing is 25%. Evidence gathering is also 25. So the two topics alone is 50. So this is a very important area we have come to. You cannot go and do audit without report writing. So we are going to discuss report writing. Now, the auditor's reports and the meaning of a true and fair view. The meaning of true and fair view. Now, let's go. The auditor's report on the financial statements is the only direct communication between the auditor and the owners of the company. So along the line, if you are doing auditing, you don't communicate with the shareholders. The only instance you communicate to the shareholders is what? When you have finished the work and you are writing a report and the report goes directly to them. So that is the only direct communication between you, the auditor, and the shareholders. Therefore, we need to listen attentively to this particular area. It's a very appetizing area for the examiners. And every sitting, there is always what? A question around this area. Now, the first thing you have to know is what is expectation gap. They say the term expectation gap refers to the fact that the public perception of the role and responsibility of the external auditor is different from his statutory role and responsibility. And it's true. What the public perceive the auditors to be doing is different from what the standard and the law say we should do. So there is a difference between what the public perceived to be the role of the auditor vis-a-vis what the law says we should do. That is the expectation gap. Now, how do you respond to expectation gap? There's a difference between what the public perception is about auditors and what actually the auditors do. Therefore, we need to respond to it. We need to close the gap. And how do you what? Respond to the expectation gap. Now, responses to the problem of expectation gap have varied between countries to country. So every country has its own way of what? Closing the gap between the expectation and what actually auditors do. So in some countries, corporate governance codes have changed to strengthen the role and responsibility of directors for sound internal control and accounting systems. Now, electronic reporting. Many companies now publish their annual report on their websites. This method of electronic reporting has implications for the auditor. It is considered good practice for the auditor to check that the electronic form of the financial statement and the auditor's report are identical to the paper copy. Now, meaning of a true and fair view. Now, when the auditor writes a report and says it is true and it is what? Fair, what does it mean? If you say something is true, it means that one, it is appropriate to think of true and fair view as a combined phrase. In practice, true can be interpreted as providing objective assurance that the information contained therein is factually without error. So when they say true, you said true, it means factual. And when you say fair, it means fair also can be what? Interpreted as providing objective assurance that the presentation and impression are not misleading. That's the meaning. So true means factual, and then fair means not misleading. Now, so in summary, let's see what it means. True and fair means. That's in summary, true and fair will normally imply compliance with all relevant what? Legislation and accounting standards. So when you say something is true, you are telling the users of the financial statement that the financial statement has been prepared in regard or in compliance with what? All accounting standards and the relevant legislation. Then the use of accurate figures or best possible estimates. Use of what? The figures are accurate and their estimates are also what? Accurate. The meaningful presentation and disclosure of information. That means information are presented, the way they are presented is exactly what the standards say they should present them. Then the avoidance of biases, distortion, and manipulation of figures. Then non-concealment of material information. You are concealing any. Now we have two types of reports, two types of what do you call it, opinions that we come out with. We have what we call unmodified audited reports. When they say something is not modified, then it means something. So ISA 700, 701, and 720 explain all those things. When they say unmodified, the definition of unmodified audited report, that's unmodified audited report is an auditor's what? Report containing an audit opinion not modified in any way, either by changing the unmodified opinion to a modified opinion, an adverse opinion or a disclaimer of opinion, or by adding an extra paragraph such as an emphasis of matter or other matters paragraph after the opinion paragraph. What it means is that if it's unmodified, that is when we say it is true and fair. Anything apart from true and fair is modified. In Britain, they say true and fair, but in US, we say fairly representing. Fairly representing. As a 700 requires the auditor to give an unmodified opinion when he concludes that the financial statements have been prepared in all material respects in accordance with applicable financial reporting framework. What they are just telling is that under what condition can you write an modified opinion? When you find out that in all material respects, in accordance, the financial statement is prepared in accordance with what? Applicable financial reporting framework, then it is true. And modified opinion provides a high level of what? Assurance. High level of what? Assurance that a professional, independent examination of the financial statement has not revealed any material misstatement in those financial statements. Now, in reaching his audit opinion, how do you reach your audit opinion? In reaching his audit opinion, the auditor is required to evaluate whether he has obtained sufficient appropriate audit evidence as to whether the financial statements are free from material misstatement. That's number one. Number two, uncorrected misstatements are material, individually or in aggregate. Then three, the misstatements have been prepared in what? The financial statement have been prepared in accordance with the requirement of the applicable financial reporting framework, which for a fair presentation framework will include evaluating whether the financial statements give a true and fair view. Now, and in particular, whether the financial statement adequately describe the relevant financial reporting framework. The financial statements adequately disclose the entity's significant accounting policies. The significant accounting policies are appropriate and consistent with the relevant what? Financial reporting framework. Then accounting estimates are reasonable. The information in the financial statement is relevant, reliable, comparable, and understandable. All these things go into the financial statement and you say that it's true and fair. The financial statement provide adequate disclosures. There should be disclosures in the notes. And then the terminology used in the financial statement is appropriate. If all these things are there, conditions are there, then you can say the financial statement what? True and fair. Basic elements of the auditor's report. Yes, in every report, audit report, there are elements. That means the components of the report. So, as ISA 700 states, he said there should be title. Every report should have what? A title. The title is always independent auditor's report. That is what we normally put down as a title. because we are not associated with the organization we are auditing. So we are independent. So we say independent auditors report of so so and so and so. Then there should be addressee. And at this instance, the addressee should be what? The shareholders. The addressee should be what? The shareholders. Then auditor's opinion, your opinion. How have you seen it? What is your results? What is your outcome? What is your opinion on it? Is it true and fair or otherwise? Then basis for opinion. Why are you saying it is true and fair? Then you quote all what we said. You have seen that all the financial statement have been prepared in accordance with the so and so and so and so. Then you also consider what? Going concern, material uncertainty also in the report, if any. That's if applicable. If there is any material uncertainty in the organization, which you see that can impact negatively on the organization, then you also go, that's going concern. Then key audit matters. Key audit matters are issues that you have already communicated with management in the management letter, but they are so important that the shareholders also have to have copy. Therefore, we call them key audit matters. Then other information, if applicable. So that is the content of what? Auditors reports. Responsibility for the financial statements. Then you must state who is responsible for the financial statements. Then auditor's responsibility. Then other reporting responsibility, if applicable. If you are doing any other job apart from the auditing. The name of the engagement partner. Then auditor's signature, auditor's address, date of the audit report. All this must go into the report. That is the content of the audit report. When you're writing a modified audit report, and if it's modified, well, the content they stay the same, but with small variation. These elements are designed to achieve the objectives of ISA 700, which are for the auditor to what? Form an opinion on the financial statements based on the evaluation of the conclusion drawn from the audit evidence obtained, and express that opinion clearly through what? A written report that also describes the basis for that opinion. Now, let's go to the title. The title's report, the auditor's report shall have a title that clearly indicates that it is a report of an independent auditor. Then obviously, the report shall be appropriately addressed as required by the circumstances of the engagements. The auditor's opinion, that is the most important now. The first section of the auditor's report shall include the auditor's opinion and have the heading opinion. So always there is opinion paragraph. Then the basis for the opinion should follow the opinion paragraph. The basis for opinion paragraph shall be like state the audit was conducted. You must state that the audit was conducted in accordance with what? International standards on auditing. That is the base, okay? Then refer to the section of the auditor report that describes the auditor's responsibility under the ISIS. Include a statement that the auditor is independent of the entity in accordance with the relevant ethical requirements relating to the audit and has fulfilled the auditor's other ethical responsibility in accordance with what? In accordance with these requirements. You must also state whether the auditor believes that the audit evidence the auditor has obtained is sufficient, yes, and appropriate to provide a basis for the auditor's opinion in the opinion paragraph. Now, when you concern in the reports, material uncertainty, if applicable, if it's not applicable, don't put it there. If it's not applicable, so all the things that you see not if applicable means that they are not compulsory. If there is an issue which is a going concern issue and it's a material uncertainty, then you bring it in. The use of the going concern basis of accounting is appropriate, but a material uncertainty exists, and the auditor considers that adequate disclosure about the material uncertainty has been made in the financial statements. Then the auditor shall express and modify opinion and include an extra paragraph in the auditor's report entitled Material Uncertainty Related to Going Concern. So that is the format. Key audit matters, as we said previously, are issues that pertain to what? Listed entities and any other audit where the auditor is otherwise required by law or regulation or decide voluntarily to communicate key audit matters. The auditor shall communicate key audit matters in accordance with what? ISA 701, which you shall see below. Now, other information, if applicable, it's not compulsory anyway. If it is applicable, then it's okay. Now, let's see. Where the auditor has obtained and or additionally in the case of listed companies, also expect to obtain subsequent other information. The auditor's responsibility related to other information as at the date of the auditor's report. The auditor shall include other information paragraph. It's not compulsory. It's if applicable. Okay. The responsibility for the financial statement, as we all know already, it is management responsibility. It should be stated in the report that it is management's responsibility to prepare the financial statement, which they did, and by selecting appropriate accounting standard, etc., to prepare. All right. Now, auditor's responsibility is also should be added in the report. This section states that the objectives of the auditor are to what? Obtain reasonable assurance and then issue an auditor's report that includes the auditor's opinion and then states that reasonable assurance is a high level of what? Assurance, but it's not a guarantee that an audit conducted in accordance with ISS will always detect a material misstatement when it exists. So let them know that it is your responsibility to prepare audit reports, audit the financial statement, and report on it by selecting appropriate auditing standards. Then state the misstatement can arise. State that misstatement can arise from fraud or error. Tell them that auditing is not what 100% what do you call it. So it is a reasonable assurance, meaning that there may be some errors or some fraud, but it may not be detected. And then describe materiality, and then state that the auditor exercises professional judgment and maintains professional skepticism throughout the audit. All these features in the auditor report, but in a brief way. Other reporting responsibility. If there is no reporting responsibility, don't force it. And if there are other reporting responsibility, then it comes under this. In such a situation, the auditor is required to include a statement in the auditor report which states that the accounts do not give all the information required in the Companies Act of 1963 at 179 and details the required particulars such as far as the auditors are reasonably what? Reasonable to do so. Now, names of engagement partner, as usually, the auditor's name and the firm, and then what? The auditor's signature and auditor's address, and then the date of the auditor's report. These are very key. Now, let's understand what is key audit matters. That is ISA 701. It is very important that in the report, key audit matters should be there. And key audit matters are issues that have been captured in the management letter or letter relating to a report relating to the management. And those issues are so important that the shareholders also need to get those information. The objective for International Audit and Assurance Standard Board revision was to make the auditor's report more informative and used for the internal users. So key audit matters must be communicated to what? In the audit reports. In the auditor report of all public interest entities, and when the auditor is required by law or regulation to communicate key audit matters in the auditor's reports. Now in Ghana, the following entities meet the definition of public interest entities. For example, which is the purpose of complying with the communication of key audit matters. That's companies that have made invitation to the public. That is those companies that are registered on the stock exchange. The mutual funds licensed by Securities and Exchange Commission. Then investment what? Advisors licensed by SEC. Unit trust licensed by SEC. Companies operating the basic national security, national social security scheme, tier 1. Then trust companies licensed by the National Pensions Regulatory Authority. All this they qualify for what? Key audit matters. Key audit matters. Private pension schemes registered by National Pension Regulatory Authority, tier what? 2 and 3. The deposit taking institutions, they are also qualified. Life insurance companies, the non-life insurance companies, reinsurance companies, and state-owned enterprises regulated by the State Enterprises Commission. All these institutions qualify for key audit matters. Now, determining key audit matters now. What is key audit matters? ISA 701 states that those matters that in the auditor's professional judgment, professional judgment, were of most significant in the audit of the financial statement of the current period. Key audit matters are selected from matters communicated with those charged with governance. So the management letter, those things have also been stated already. So you select them from it. So key audit matters are defined with reference to the auditor, not the user. So areas that require significant auditor attention in performing the what? Audits. Key audit matters are a standard element of all unmodified auditors report for public interest entities. And then key audit matters therefore do not represent modification to the auditor's reports. Explains that in determining CAM, which is key audit matters, the auditors shall take into account areas of higher assessed risk of material misstatement. So note that areas that you assess risk which are very high, that is one of the things you capture as key audit matters. The second one is significant auditor judgment, where there are judgments relating to areas in the financial statement where the management has made a judgment like provisions and the rest, estimates and all those things. That is one of the items you have to include in the key audit matters. The next one is the effect of significant events or transactions that occurred during the period. Any significant events that happen, any effect it has on the financial statement, key audit matters. Then the auditor determines which of the above matters were most significant in the audit, and hence are the key audit matters. So that's what they are telling you. All right, let's continue. Communicating key audit matters. Those key audit matters need to be communicated. So key audit matters are described in a separate section in the auditor's report under the heading Key Audit Matters. For each CAM, the description must explain why the matter was considered to be one of the most significant in the audit and therefore determined to be a key audit matter. Then how the matter was addressed in the audits. The next one is interaction between key audit matters, ISA 7 and 5, and then ISA 570. However, in such instances, these matters shall not be described in the CAM section of the auditor report. CAMs are not a substitute for expressing a modified opinion in accordance with ISA 7 and 5. Where a material uncertainty relating to going concern exists, the auditor shall insert a separate paragraph into the auditor's report entitled Material Uncertainty in Relation to Going Concern, and describe the material uncertainty therein. What they're just telling you is that if you insert CAM, which is key audit matters, in the report, that is not modifying their opinion. But where there are uncertainties, then in that material uncertainties in the going concern of the organization, then you capture it under what? Material uncertainty in relation to going concern. The CAMs are not presented when the auditor disclaims an opinion. So very soon we shall come to the opinions that we shall give. Anytime you are what? Writing opinion and key audit matter, once you are disclaiming, it means you need not to bring what? Key audit matters at all. Then interaction between key audit matters and emphasis of matter. The objective of an emphasis of matter paragraph is to draw attention to what matters included in the financial statement and related disclosures. So what they are saying, emphasis of matter paragraph. That is, there is an issue in the financial statement already, whether in the notes or on the face of the financial statement, which you want to emphasize. You want to emphasize. You want to stress on it so that management will be aware of the shareholders will be aware of that one. So we call it emphasis of the matter paragraph. Emphasis of matter paragraph shall only be used to highlight matters that are not considered to be key audit matters. So if you have added the thing to key audit matters, then don't emphasize it again. But once the issue is important and material in the financial statement, which you want to re-echo to the users of the financial statement, you put it under what? Emphasis of the matter paragraph. So those emphasis of the matter paragraph are issues which appear in the financial statement, which you want to re-echo. You want to lay emphasis on. Those are the emphasis of the matter paragraph. Now let's look at the interaction between key audit matters and other matters. Other matters are defined by ASA 7 and 6, related to matters other than those presented or disclosed in the financial statement. That's the fact that prior year financial statements were audited by a predecessor auditor. What I mean is that, you see, when you say other matters, it means the issue is not on the financial statement, but you want to bring it to the attention of the users for the financials. So it comes to other matters. It is not part of the financial statement. It's neither in the note or on the face of the financial statement. So you want to add it as a matter of importance. So given that comes, that's key audit matters are always drawn from matters relating to the presented and disclosed financial statement, there shall be no overlap between other matters and key audit matters. Auditor report prescribed by law or regulation. If the auditor is required by law or regulation to use a specific layout or wording of the auditor's report rather than the wording in ISA 700, then the auditor's report may only refer to ISAs if it includes as minimum the following elements. What they are saying is that you cannot say you have audited in accordance with what? International standard on auditing, unless the title, you are independent, the addressee is shareholders, an opinion section containing expression of opinion on the financial statement and reference to the applicable financial reporting framework used, and identification of the entity's financial statement that have been audited. A statement that the auditor is independent of the entity in accordance with the relevant ethical requirements relating to the audit and has fulfilled the auditor's other ethical responsibility in accordance with these requirements. Where applicable, a section addressing a material uncertainty of what? Going concern. And then where applicable, a key audit matters section should be inserted. Where applicable, a section addressing other information can also be what? The moment they say where applicable, then it means it's not compulsory. Okay. Then a description of management responsibility for the preparation of the financial statement and identification of those responsible for the oversight of the financial reporting process. So this thing has been captured here. Let's go. Audits conducted in accordance with both ISS and local auditing standards. So if you have done the audit in accordance with international standard for auditing and that auditing and local auditing standards, then it means you should follow. In this case, the audited report may refer to ISS in addition to the what? National auditing standard, but only where there is what? No conflict between the national auditing standard and ISS, where which would have led the auditor to form a different opinion or not to include an emphasis on matter paragraph in the rest. Then, if the report followed the wording of national auditing standards, it includes as a minimum the element as specified above. Then, when the report refers to both national auditing standard and international standard on auditing, it shall clearly identify the jurisdiction of origin of the national. Now let's go. An audited supplementary information presented with what? The audited financial statement. Now, auditors, after auditing the financial statement, other reports are also added to the financial statement. That goes to the what? The board, the shareholders, sorry, to the shareholders or the users of the financial statement. And we need to audit or go through those documents. So determine through discussion with management which document or comprises the annual report, meaning that the annual report may be added to what? The financial statements. So find out which particular document or discuss with management which particular document will be added to what? The audited financial statement. Make appropriate arrangement with management to obtain in a timely manner final version of the documents comprising the annual report and read the other information in order to justify material inconsistent with the audited financial. What I just say is that when the board is going to meet the shareholders at the board meeting, at the shareholders meeting, they add other documents, other reports, like the management report and other reports to the financial statement. What they are just telling us is that we should be very careful and make sure that all the information captured in the financial statement are the same as those captured in the what? What do you call it? The reports. So there should not be different information. That's what they are telling. Then other information reporting. Yes, the auditor's report shall include a separate section with the heading other information. So yes, if there is any other information you need to add, you can have it and say other information. When at the date of the auditor's report, for the audit of listed companies, the auditor has obtained or expect to obtain other information. For the audit of non-listed companies, the auditor has obtained some or all the other information, etc., etc. So those are the information. That's how the report structure is. For listed companies, other information, if any, expected to be obtained from, and then a statement that the auditor's opinion does not cover the other information, and then a description of the auditor's responsibilities relating to the reading, considering, and reporting of other information as required by ISA 720. When other information has been obtained prior to the date of the auditor's report, either a statement that the auditor has nothing to report, then if the auditor has concluded that there is an uncorrected material misstatement of the other information, a statement that describes the uncorrected material misstatement of the other information. Audit reporting and the Companies Act of 1963 at 179. The report by the auditor shall consist of a report addressed to the members of the company, on the books of account of the company, and on every balance sheet, profit and loss account, and all group accounts to be sent to the members and debenture holders of the company. Now let's come to modification now. I told you already that when they say I modify audit opinion, that's where you get true and fair. But anything apart from true and fair, you are modifying the reports. You are modifying the reports. So modification is the next one we are going to of auditor's report. Now, before issuing a modified report, the auditor shall discuss with management the reason for the modification. They are just telling you that if you want to modify, the first one is what we call the standard audit report, or what do you call it at the usual or the usual audit report. Yes, you have, and they are saying that if you are going to modify because of A, B, C, D, have a meeting with the management and discuss the issue with them. That the report, the opinion you are coming out is not what a modified. It is a modified opinion. Discuss with them. Then, if management make the necessary adjustment, the reason why you are going to modify it, if management agree to and then make the adjustment, the auditor will not need to issue a modified report. That's what they're telling you. Once they accept and they corrected it, there's no need for what? A modified opinion. If management refuse to make the amendment, a modified report may be the only only course of what action available to the auditor. Yes. If they say they will not correct it, then the only way available is what? To modify the opinion. The modification is the problem now. So the auditor report is said to be modified where either a matter arises which does not affect the opinion given by the auditor, but which gives rise to an emphasis of matter paragraph or an other matter paragraph in the auditor's reports. Then a matter arises which does not also affect the opinion issued on the financial statement. This will give a rise to what? A qualified opinion or a disclaimer of opinion or an adverse opinion. So these are the three types of modifications we have. The three types of modifications we have are: one, a qualified opinion, a disclaimer of opinion, or an adverse opinion. These are the three type of opinions that we have, which we are modifying it. Emphasis of matter paragraph and other matter paragraphs. And they are telling you that emphasis of a matter paragraph draws the attention of what users to an item that is included in the financial statement. Already, it is there, and you just want to lay emphasis on it. You have to re-echo it. That's why. Know that if such a matter is considered a key audit matter, then it shall be addressed in the key audit matter section, not emphasis on the matter paragraph. Another matter paragraph deals with a matter which is not included in the financial statement, but which is relevant to an understanding of the audit. So that one is not in the financial statement, but you think it is very vital for the shareholders or the users of the financial statement to be aware of those issues. So that one is other matters. So there is plenty emphasis on the matter again, which they are just trying to explain. Then circumstances in which an emphasis of matter paragraph may be necessary. So conditions that would need emphasis of the matter paragraph in the report, where there is an uncertainty relating to the future outcome of what? Exceptional litigation or regulatory what? Action. That's one. Two, a significant subsequent event that occurs between the date of the financial statement and the date of the auditor's reports. The two of them. Then, where the entity has adopted a new international financial reporting standard early, and that has had a pervasive effect on the financial statements. And then the last one, to draw attention to a major catastrophe that has had or continue to have a significant effect on the entity's financial position. Now, access requiring emphasis of matter paragraph. So you read the access that require the emphasis of the matter paragraph. Other matter paragraph is also there. So they are saying the positioning of the other matter paragraph is in the auditor report requires judgments. ISA 706 provide the following guidance. 1. The illustrative auditor's report in the appendix, which we discussed already. Then, when an other matter paragraph is included to draw users' attention to a matter relating to other reporting responsibilities addressed in the auditor's report. And then when irrelevant to all the auditor's responsibilities or what? Or users what? Understanding of the auditor's report. The other matter paragraph may be included as a separate section following the reports. Then circumstances in which an other matter paragraph may be necessary. Where? Under what condition can it be necessary? Where the auditor is unable to resign from the engagement, even though the possible effect of a limitation of scope imposed by management is pervasive. The second condition is that where local law or custom allows the auditor to elaborate on his responsibility in his reports. Then the third one is another example when an other matter paragraph might be used is when the prior year financial statements were audited by a previous auditor. Now, ISIS requiring an other matter paragraph. They have listed them all down there. Now, we say modified. When the auditor must issue a modified opinion, when do you issue a modified opinion? And we say modification means that it's not going to be true and fair again. It can either be a qualified opinion, a disclaimer of opinion, or adverse opinion. Any of the three goes into what we call modification. And they are saying, under what condition can you modify the opinion? So they are saying, ISA 507, modification to the opinion in the independent auditor report requires the auditor to modify his opinion in the auditor's report in two situations. So there are two situations that you can modify. One, material misstatements. Material what? Misstatement. When misstatements in the financial statements are material. This occurs when the auditor concludes that based on the audit evidence obtained, the financial statements as a whole are not free from material misstatement. So that is number one. Number two, limitation on scope. Limitation on what? Scope. So the first one, let's see the first one again. The first one is talking about material misstatements. If it is material misstatement, then it means it's running towards what? Adverse. It's running to what? Adverse. But if it is what? Scope limitation, then it's running towards what? A disclaimer. But I'm going to explain them into detail. So ISA 705 lists three types of modified opinions: a qualified opinion, an adverse opinion, and a disclaimer of opinion. So now let's see. The table that's ahead, if you look at the first column, that's nature of matter giving rise to what? Modification. What will enable you to give rise to what? To modify the opinion. Then in the middle, then they say material but not pervasive. The issue is material, but it is not what? Pervasive. Then if you come to what? The extreme right, it is material and it is pervasive. Now the word we shall use in giving the opinions are materiality and pervasiveness. What does pervasive mean? Scattering round, can be seen round, is common to. So anything that is common, anything that is spread across, that means it is what? Pervasive. The most important is materiality and pervasiveness. So let's look at the first item. Financial statements are materially misstated. They are what? Materially what? Misstated. If they are materially misstated and it is not pervasive, it is not what? Pervasive, it is not cutting across all the units, then you qualify the opinion and say that The financial statement is true and fair, except this area. For example, if it's payroll, where the problem is coming from, you say the financial statement is true and fair, except there is a problem with our payroll. If it is procurement, then that is except. When it is material but not pervasive, that's the word. But if that's where you qualify the opinion and say except for this area. But when you come to it is material and it is pervasive, it means the issue is material and it cut across. It can be seen in almost all the department, or it can be it's common to everywhere. Then it is material and it is what? Pervasive. And under that circumstances, once it is material and pervasive, and it is the financial statements misstated, the misstated one, this one, the misstated, yes, this misstated. It's a misstatement. Therefore, if it is material but not pervasive, you qualify. You say, oh, the financial statement is true and fair, except the payroll or except where the problem is. But if it's in material, there is a misstatement in procurement, misstatement in payroll, stores, everywhere there are misstatements. Then it is material and it is what? Pervasive. And at that circumstances, then you write adverse opinion by saying that the financial statement is not true and fair. Then the next one that we are going to learn, which will guide us, is that auditors always come out with their report of their opinion based on what? Sufficient and appropriate audit evidence. Sufficient and what? So the two words, misstatement and then what? Scope limitation. Limitation of scope. So once you are able to what? You were unable. That means you couldn't get or obtain sufficient what? Appropriate audit evidence. Then what do? Once that particular issue is material but not pervasive, it is material but not pervasive. Probably it happened only in the payroll or in a procurement or in only one particular area. It's not pervasive, so it's only restricted to those areas. Then you qualify the opinion that the financial statement is true and fair, except this area where I was unable to obtain evidence, sufficient appropriate audit evidence. But when you come to what? Another one, which is it is material, the what do you call it? The misstatement or limitation of scope is material, and it is what? It is material and it's pervasive, which means it is can be seen all over. Then you disclaim and said this financial statement is not true. Oh, sorry, I cannot comment on the financial statements. I cannot comment on the financial statement. That means you are disclaiming. So qualified opinion, they have given it there. A qualified opinion, audit opinion shall be given when, in the opinion of the auditor, there is a material misstatement or a limitation on scope, and the effect on the financial statement is material but not pervasive. The word is what? It's no more. Okay. It is material but not pervasive. That means you qualify the opinion. So, a qualified audit opinions are sometimes called except for opinions, because the auditor's report shall state that in the auditor's opinion, the financial statement give a true and fair view, except the matter or matters described in so and so. Now, let's go to the next one. The meaning of pervasive, disclaimer of what? Opinion or adverse opinion. Now, what is pervasive? Pervasive effects on the financial statement are defined by ISA 705 as those that, in the auditor's judgment, are not confined to specific elements, accounts, or items of the financial statement. That means they are scattered over, are also confined to specific elements in the financial statement, but these represent a substantial proportion of the financial statements, or in a relation to disclosures in the financial statement, are fundamental to users understanding of those statements. The difference between a material and a pervasive modification is a matter of judgment. Now, limitation on scope. What is the limitation on scope? That limitations on scope occur when the auditor is unable to obtain sufficient appropriate audit evidence about something that is material. So that is what we call what? Limitation. ISA 7 and 5 suggests that this may happen as a result of what? Circumstances beyond the control of the entity, such as when the entity's accounting records have been destroyed. Then circumstances relating to the nature or timing of the auditor's work. An example is when the auditor is appointed too late to enable him to attend the physical inventory count. Then limitation imposed by management. Sometimes management can also impose their own limitation. The management of the client entity may prevent the auditor from obtaining the audit evidence required. For example, preventing the auditor from observing the physical inventory counts, preventing the auditor from asking for confirmation of specific amount balances. Now, management imposed limitations that's limitations that management will impose on the auditor. If management refuses to do this, the auditor must communicate the matter to those charged with governance and then consider whether it is possible to perform alternative audit procedures. So now, alternatively, if it is not possible to obtain audit evidence in another way, and the matter is material but not pervasive, the auditor must give a qualified opinion. On the other hand, if it is not possible to obtain audit evidence in another way, and the matter is material and pervasive, the auditor must resign from the audit work where practicable and not prohibited by law or regulation, and if not practicable or possible, issue a disclaimer of what? Opinion. So, modification of audit reports is in three phases. There are three phases there, but that modification can only happen because of misstatements or the auditor was unable to obtain audit evidence. So we call it scope limitation and misstatements. If it is misstatement, that misstatement is material but not pervasive. You qualify the report by saying except for. But if it is what? Material and it's pervasive, then you write what? Adverse opinion. The financial statement is not true and fair. If it is about what? Unable, that is scope limitation. If it's scope limitation, then if it is scope limitation, also the same thing that we said. If it is material and it's not pervasive, you qualify the opinion by saying except for. But if it is material and what? Pervasive, you disclaim the opinion. So these are basis for modify opinion paragraph. So they are all here. Okay. Yes. One particular thing we need to know is also when do we decide to give a modified opinion? The auditor will give a modified opinion only if he is certified that the reasons for giving a modified opinion are justified, and B, the management of the client entity are unable or unwilling to act to remove the necessity for a modified opinion. These are the two conditions. One, where they give the reason is that if you think that the modification is justified. Two, where management are unwilling to remedy the situation, then you modify the opinion. Now, the auditor shall first of all certify himself that there is no acceptable reason for the management review, and that the asset should be depreciated. The auditor should review the audit file and check for any information about this matter from previous audits. He should consider whether there might be an acceptable reason for a departure from the requirement of our international financial reporting standards and so forth. So if the auditor is still satisfied that management is incorrect in the opinion, he should what? Meet with the management and discuss the reasons for not depreciating the asset. It was the question said above. Then you must obtain a representative from them confirming that the asset will not be depreciated. That's through the example that we discussed. That means this particular asset will not collect a representation from the management, a written what information from the management to the auditor that they decide that this asset should not be depreciated. Decide whether the effect of this action by management on the financial thing is material. That is the second thing. Decide if it is material. And if it's material, is it pervasive? If it's pervasive, so if it is so what form of modification or modified opinion is necessary? Ask yourself. Then warn management that the audit opinion will be what? Modified. Unless management what? Changes their view or rectify the situation. If management still refuse to change their view, issue a modified opinion, which will be either a qualified opinion or an adverse opinion, depending upon how it is. Okay. So let's go further. The auditor's responsibilities relating to other information. So other information which will be added to the auditor's opinion, you have a responsibility as far as ISA 720 is concerned. Now, the nature of other information. Then they say the published annual report of major companies contain a significant amount of information that is what? Not required by status or by accounting standards. The annual financial report is often used partly as what? A public relations document, communicating a wide range of information from the company to shareholders and others, possibly in a report from the chairman or the chief executive officer. So apart from your own financial statement you audited and your audit report, other informations are also added to the financial. In doing this, you should note the following: the scope and contents of the report that is added to your audited financial statement. Then the comments and report on corporate governance matters, if any. Then it will also be helpful for your heading for auditing studies to look at the form and content of the auditor's report, the accounting policies applied, any accounting or auditing problems that may be evident from the financial statements. Check for all these things. So, ISA 720, the auditor's responsibility related to other information, is saying that you must try to what? There is a possibility that the credibility of audited information may suffer if information that has not been audited is published together with what? Audited information. Yes. Once the information is not audited and is added to the audited information, people will think that the auditor has also gone through, and therefore it will the credibility of the audited financial statement will suffer. And then the unaudited information contains error, especially when it contains error, then it's very grievous. It's inconsistent with the audited information. So these are the two conditions. For this reason, ISA 720 requires the auditors shall read this other information, and in doing so shall consider whether there is a material inconsistency between the other information and the financial statement, and consider whether there is a material inconsistency between the other information and the auditor's knowledge of it. Let's assume that the financial statement given to you, per all the ratios and all calculations, the sales has increased about 10%. Now, in the, let's say the reports, other information added, they say the sales has increased 20%. You see, the other report is saying 20%. Whilst the financial statement says what? 10%. So you could see that inconsistency exists. So it is your duty to check for all these things before they are released to what? The public. If the auditor identifies that a material inconsistency appears to exist, the auditor shall discuss the matter with management and, if necessary, perform other procedures to conclude whether a material misstatement of the other information exists, a material misstatement of the financial statement exists, and then the auditor's understanding of the entity and its environment needs to be what? Updated. So auditor's response. If a material misstatement of the other information exists, the auditor shall ask management to correct this and then check the correction has been made. If management refuses to make the correction, the auditors need to what? Communicate with those charged with governance to make the correction. If a material misstatement of the financial statement exists, or the auditor's understanding of the entity and its environment needs to be updated, the auditor shall respond appropriately in accordance with what? The other ICES as follows. So they are giving us so many ICES there. Now, reporting. The auditor report shall include a separate section with a heading Other Information when at the date of the auditor's report for the audit of a listed company, etc., etc. The impact of the auditor's report on of opening balances and comparatives. The opening balances for the opening balances for this year was a closing balance last year. So we normally match the previous audited financial statement against this year. So that's what you call comparatives. So your role, they say the impact on the audited report of opening balances. So opening balances are very important. If there is an error in the closing balance, it will have an effect on the what? The opening balance. And if opening balance is different from the closing balance, it will make this year's financial statement what? Not correct. Now, that is ISA 510, initial audit engagement. Assuming you are the first man to audit, or you get the audit at the first time. Probably somebody was auditing it, but you are taking the business now. Check the opening balance very well. The auditor's report is required by ISA 510 to be modified where the auditor is unable to obtain sufficient appropriate audit evidence on the opening balances. They are telling you that you need to modify the opinion when you are not able to what? Obtain sufficient appropriate audit evidence on the opening balances. Then you are also not able to conclude that there is a misstatement in the what? Opening balance. They are saying that if you conclude that there is a misstatement in the opening balances, then you need to what? Modify the opinion. If it also concludes that accounting policies have not been consistently applied, you need to modify the opinion. Then the prior period's auditor's report was modified. Once the prior period's report was modified, then this year's one need also to be modified. Okay. Now let's look at ISA 710 comparatives. So you could see how comparatives are done and look at the circumstances and look at the ISA 710 requirement. Let's assume that the circumstances one, the auditor gave a qualified opinion for the previous financial period and the problem remains unresolved. What do? This year, you modify this year's auditor reports. If last year, the auditor finds a material misstatement in the prior period financial statement on which an unmodified opinion was previously given, and the corresponding figures have not been appropriately restated, then this year give a qualified or an adverse opinion on the current period financial statements. Then a prior period financial statements were not audited at all. Then use another matter paragraph to state these facts that However, the auditor remains responsible for obtaining sufficient and appropriate audit evidence on opening balances. Okay. So other matter sections in the auditor's report, they must state things like if we find the financial statement of the prior period were audited by the predecessor auditor. That means you didn't do it, therefore you need to state it. Then the type of opinion expressed, if modified, if previous audit was modified, the reasons why, and the date of that report. So you need to state all those things when the impact of going concern on the auditor's report, ISA 570. Going concern is simply making sure that the organization continues to be in existence for foreseeable future. That is going concern. And the financial statement we prepare it in two folds. Some of the items go to income statement, others go to position statement. Why? On the base that the business will be in existence for foreseeable future. So going concern is very important. That is ISA 570. The impact of it. So if indications are found which suggest that the going concern basis might not be appropriate for preparing the financial statement, the auditor is required by us at 570 to consider implications for this for his audited report. The form of the report will depend on the auditor's judgment. There are two possible views he could take. One, the use of going concern assumption is appropriate but a material uncertainty exists. Or the use of the going concern assumption is inappropriate. If management is unwilling to make or extend a going concern assessment, the auditor is also required to consider the implications of this for his auditor's report. Now, where the use of the going concern assumption is appropriate but a material uncertainty exists, where the auditor considers that the going concern assumption is appropriate but a material uncertainty exists, he must consider whether the financial statements are adequately describe the principal events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. And management plans to deal with what? Those events or conditions. Or disclose clearly that there is a material uncertainty related to what? Events or conditions that may cast significant doubts on the what? Entity's ability to continue as a going concern. So what I mean is that there are some factors that may not make your client company be in existence for foreseeable future. They are classified into three. The financial issues that may cripple the going concern of your organization or your clients. Then we have operational issues which may not augur well for your company to be in existence for foreseeable future, and then others. So going concern issues are classified into three: those that are related to financial, and those that are operational, and then what? Others. Now, they say management's attitude to disclosure of material uncertainty. The management of a client company will probably be reluctant to include a disclosure about material uncertainty in relation to the going concern assumption. There are several reasons for this. Admitting that there is a material uncertainty about whether the company can continue as a going concern for the next 12 months can be seen as a sign of management failure. So because of that, they may not disclose it. A statement that there is a material uncertainty about the ability of what? The company to continue in business will make the situation even worse for the company. Then the third one is employees will become more concerned for the job security, and many might look for jobs with the other what? Companies. Where the use of the going concern assumption is inappropriate. So where you see that the financial statement has been prepared based on the going concern assumption, That means the financial statement is divided into two, where we have income statement, items going to income statement, others going to what? Position statement. So if you prepare the financial statement in that manner, it means the assumption is that your financial statement is what? The going concern is appropriate. Base is appropriate. Therefore, you are preparing it in that way. But when the what do you call it? Going concern is not, assumption is not appropriate. We prepare the financial statement in two ways: either realization account or break up what accounts. Now, communicating with those charged with what governance. ISA 270. They are saying that the auditor's objectives in respect to ISA 260 are to communicate his responsibility and give an overview of the planned scope and timing of the audit. They obtain information relevant to the audit, provide timely observation arising from the audit, which are significant to management's responsibility to oversee the financial reporting process, promote effective communication between the auditor and those charged with governance. Matters to be communicated. So there are issues to be communicated. One, his responsibility in relation to the audit, including what? Notification that he is responsible for forming and giving an opinion on the financial statements prepared by management. And the audit does not relieve management or their or those charged with governance of their responsibility. And an overview of what? The planned scope and timing of the audits. Wow. Okay. Any significant finding from the audit, these are often called the management letter points and are usually communicated along with any deficiency in internal control as required by what? ISA, ISA 265. So auditors write two what? Reports. First one is management letter to those charged with governance, and then we also have the audit report itself, which you have two types of audit report. You have the long form of report and the short form of. The long form of the report is the management letter, which is detailing all the weaknesses in the internal control system put in place by management and advising them to correct those what do you call it policy issues. That is the management letter, which we call the long form of audit report. The other type of report is the short form of report, which we call statutory report. That's where true and fair view are. So they are saying that the auditor's view on the entity's accounting policies, estimates, and financial statement disclosures should be communicated to those charged with governance. Then any significant difficulties encountered during the audit should also be what? Captured. Any significant matters arising for the audit already brought to the attention of management, written requests and then requested, and any other matters arising from audit that are significant to the oversight of the financial reporting. Then for listed companies, it's compulsory. You must be made in writing. You must make in writing that the audit team or firm have complied with relevant ethical requirements in respect of what? Independence, and of all matters relevant to independence, such as relationships and non-audit fees, and the standards applies. Okay. The communication processes are like this. The communication with those charged with what? Governance may be provided either in writing or orally. It could take place as a discussion between the auditor and the appropriate level of management. The next one, communication must be made on a timely basis. Then the next is what? Communication in respect of planning matters will also be what? Likely to be made early enough to the engagement team. Actions when an auditor report is to be what? Modified. So if you want to modify the auditor's report, there are actions you have to take. Hey, actions when an auditor's report is to be made. So ISA 705 and 706 require the auditor to communicate any planned modification to the auditor's report with those charged with governance. So that is the first one. Then communicating deficiencies in internal control. Yes, ISA 265. That I told you already that there are two reports that auditors write. So if you are communicating deficiencies in internal controls, it means you are writing what you call management letter to the management or those charged with governance. Those charged with governance. So the ISA 315 covered largely an early chapter. Oh, right. This requirement is embodied in ISA 265, communicating defense in internal control to those charged with governance and management. And they are saying the deficiencies defined by ISA 265 was as where the control is designed, how the control is designed, implemented, or operated in such a way that it is unable to prevent or detect and correct misstatement in the financial statement on a timely basis. And then a control necessary to prevent or detect and correct misstatement in the financial statement. Those are the areas that we communicate to those charged with governance. A significant deficiency in internal control is one which merits the attention of those charged with governance. So examples are that ISA 265 requires the auditor to communicate significant deficiencies identified during the audit to those charged with governance, and then communicate any other deficiencies to what? Appropriate level of what? Management. And this is the management letter that I talk about. Although it is not a requirement of both ISA 315 and ISA 265, the management letter or letter of weaknesses has long been seen as an extra exercise provided by the client by the internal auditors. Yes. Specialized areas. Specialized areas. ISA 800 special considerations audit of financial statements prepared in accordance with what special purpose frameworks. So what it means is that there may be instances that you need special purpose financial statements. They are saying although such special consideration cover acceptance of the engagement, planning, forming an opinion, etc. The bulk of the ISA is concerned with what reporting, and auditors what report on such financial statements will add credibility to those financial statements. Areas required forming an opinion and reporting considerations. ISA 810 engagement to report on summary financial statements. Summary financial statements. The objectives of the auditor per ISA 810 are to determine whether it is appropriate to accept the engagement to report on summary financial statements, and if engaged, to form an opinion on the special what financial statements based on evidence obtained and express that opinion clearly. Now, requirement of ISA 810. The auditor shall report on the special financial statement what? Unless he has already issued an opinion on the full financial statement from which the special what? Summary financial statements are derived before accepting an engagement to report on SFS. The auditor shall decide whether the criteria applied by management in the preparation of the special financial reportation are acceptable, obtain a management agreement, preparing the financial statements, etc., etc., etc. This man, you just did the thing, things that are not necessary. Thank you very much.